It's surprising how many people approach retirement with little more than hope. They work for decades, save what they can, and simply hope it's enough. I find that deeply unsettling because hope isn't a strategy, especially when you realize at 65 that the numbers just don't work. At that point, you don't get a redo. You've run out of the most valuable resource, compounding years. So I want to be direct about something today. There are 5 assets you must have before you retire. These aren't just nice to haves, these are necessities if you want a secure and comfortable retirement built on confidence rather than fear. These 5 asset categories need to be represented in your portfolio. And I'm not talking about complex or constantly monitored strategies. These are straightforward, time-tested assets that have worked for decades, generating income, protecting purchasing power, and providing stability across unpredictable markets. Let's start with the first and most important asset, a diversified portfolio of high-quality dividend growth stocks. When it comes to retirement income, the true foundation isn't bonds or annuities. It's dividend-paying stocks, specifically dividend growth stocks, from companies with a long history of increasing their dividends. Here's the core reason why this matters. When you retire, you need reliable income, real income you can count on because you're no longer receiving a paycheck. There are really only 2 ways to fund retirement from investments. You either sell shares, gradually reducing your principal, or you collect cash flow from the assets you own without selling. If you're relying on selling shares, you're essentially living on a countdown clock. Eventually, you draw down your portfolio far enough that market drops become dangerous. And if you live longer than planned, as many people thankfully do, you can outlive your capital. Dividends solve this problem differently. With the right companies, dividends can continue indefinitely. You hold the shares, and the business sends you cash quarter after quarter. And if those dividends rise over time, your retirement income rises with them. This is precisely why quality matters so much. You're not chasing high yield at any cost. You're looking for stable businesses with durable earnings and a history of increasing payouts year after year. Think of companies with strong brands, robust balance sheets, and long dividend records, businesses that have increased dividends for decades, not just years. Names like Coca-Cola, Johnson & Johnson, Procter & Gamble, and McDonald's come to mind. I mean, boring, stable, consistent. That's what you want in retirement, reliability. Now let's consider the math. Say you retire with $1,000 invested in dividend-paying stocks yielding 3%. That's $30,000 a year in income. On its own, that might not seem like enough. But the key isn't the starting income, it's the growth rate. If those dividends grow at, say, 7% a year, the income changes dramatically over time. After 5 years, you're collecting around $42,000. After 10 years, roughly $59,000. And after 20 years, well over $100,000. That's the compounding effect most people overlook. While programs like Social Security often struggle to keep up with real inflation, dividend growth can outpace it because the underlying businesses increase earnings and raise payouts. And here's another often overlooked benefit. You didn't have to sell a single share to generate that income. Your principal stays invested, it can continue growing, and it can be passed on to your family. The dividends are income generated by productive companies, not money you withdrew from yourself. I've relied on dividends for most of my adult life. Berkshire Hathaway doesn't pay a dividend, but I've owned many businesses that do. And what I've seen year after year is that dividend income, when it comes from strong, profitable companies, is among the most dependable income streams you can build. So asset number 1 is clear. Build a diversified portfolio of quality dividend growth stocks before you retire. Not just 2 or 3 names, but think in terms of 10, 15, even 20 companies across various industries selected for their durability, not excitement, and plan to hold them for the long term. That becomes your retirement income engine. 2, a low-cost S&P 500 index fund that you generally don't touch. Now, this second asset category might seem like it overlaps with the first. People often ask, if dividend stocks are the income engine, why do I also need an index fund? The answer is that you need both roles covered, income today and growth over time. Dividend stocks provide the cash flow you can live on, but your retirement still faces risks, inflation spikes, unexpected medical costs, market volatility, or simply living longer than expected. You need a separate pool designed to grow quietly in the background, an asset you can tap only if needed. That's what a low-cost S&P 500 index fund provides. It gives you broad expo to 500 of America's largest businesses. You're not making individual stock bets. You're owning the productive core of the U.S. economy over long periods, 20 or 30 years. It has historically provided. I've always been drawn to the idea of simplicity in investing, especially as I think about the long term. There's a certain peace of mind that comes from knowing you don't have to constantly make decisions or obsess over headlines. The idea of just buying, holding, and letting time work its magic is very appealing to me. I often think of a dividend portfolio as being like a checking account. That's the money you're living off of. Then an index fund becomes like a savings account, something you only touch when you truly need to. Imagine retiring with, say, $700,000 in dividend growth stocks and another $300,000 in an S&P 500 index fund. The dividend stocks are providing the income, and the index fund is quietly growing over the years. That $300,000 could potentially grow into something far larger, maybe even millions, while your dividend holdings are still paying you income. The second asset I believe in is a low-cost S&P 500 index fund held for the long term, only to be touched in real emergencies. The third asset is income-producing real estate, or REITs. I'm talking about rental properties, residential or commercial, that bring in monthly income. This isn't your primary home, mind you. Your home is a lifestyle choice and an expense, not really an investment portfolio asset. It might rise in value, but it's not paying you anything. It's costing you in taxes, insurance, repairs, and maintenance. What really matters for retirement is cash flow real estate. Rental income tends to be stable, and it often rises with inflation too. People always need places to live and work, and as the cost of living goes up, so do rents. This means real estate can protect your purchasing power as your retirement expenses increase. Real estate also diversifies your portfolio as it's not perfectly tied to the stock market. When stocks fall, rental properties often continue generating income. Tenants still pay rent, and that stability matters when you're no longer earning a regular wage. Now, not every property is a good deal, and being a landlord isn't easy. There are definitely headaches involved, but there's a reason real estate has been a wealth-building asset for centuries. If you don't want direct ownership, you can use REITs, real estate investment trusts. These businesses own and manage income-producing properties, and they pay most of their profits out to shareholders. This gives you real estate expo without the hassle of dealing with tenants and repairs. Either way, I think real estate expo is important in retirement. It's cash flow that tends to rise with inflation and provides diversification. The fourth asset is inflation-protected government securities like TIPS or I-bonds. This asset is specifically designed to handle one of the most underestimated threats to retirees, inflation. Traditional bonds are often presented as safe, but in an inflationary period, they can be quietly destructive. Fixed payments lose purchasing power as prices rise. TIPS, or Treasury inflation-protected securities, work differently. Their principal adjusts with inflation. If inflation rises 3%, the principal value rises about 3%, and interest is paid on that adjusted amount. The goal is simple: protect purchasing power. Inflation slowly ruins fixed income retirement plans. If you retire with $50,000 a year and inflation runs 4% annually for a decade, you lose a major portion of what that income can buy. Your $50,000 ends up functioning like roughly $33,000 in real terms. That can turn a manageable retirement into a stressful one. TIPS and I bonds provide defensive stability. They're not your main growth engine, but they protect part of your portfolio from inflation surprises. A practical allocation might be 10, 20%, depending on the person. Stocks and real estate generally outpace inflation long term, but having that protection is key in worst case inflation scenarios. Think of stocks and real estate as offense and TIPS as defense. The fifth asset surprises some people, especially because I mentioned earlier that your primary home isn't an investment. That's still true, but a paid off home is one of the smartest financial positions you can carry into retirement. Not because it grows, but because it dramatically reduces your largest expense. Housing is usually the biggest cost in retirement. If you're paying $2,000 a month in rent or a mortgage, that's $24,000 a year. Over 20 years, it's close to $500,000. If you own your home outright, your housing cost falls to property taxes, insurance, and maintenance, maybe $6,000 to $8,000 a year instead of $24,000. That difference changes everything. It lowers the income you need to retire, reduces stress in down markets, and creates flexibility for medical expenses or emergencies. So, if you're approaching retirement with a mortgage, paying it off should be a serious priority. I've seen retirements crumble even when people had decent savings. The reason? Avoidable mistakes. I want to walk you through some of the most common ones I've observed over the years. One of the biggest mistakes I see is putting too much money into bonds. It's understandable. People hear retirement and immediately think conservative. But that instinct, while common, is often outdated. Bonds simply don't grow enough over the long haul, and they especially suffer when inflation rises. In fact, in inflationary times, bonds can quietly erode your purchasing power. You still receive interest, but that interest buys less and less each year. And here's the key point that many miss. Retirement can easily last for 25 or 30 years, sometimes even longer. A portfolio that doesn't grow isn't conservative, it's fragile. You need assets that can expand with the economy and protect you from inflation. Bonds can play a role, certainly, but they can't be the backbone of your retirement strategy. Stocks and real estate are essential because they offer that crucial element, growth. Another mistake I often see is not owning enough income-producing assets. People sometimes retire with a sizable portfolio, maybe $1 million or more, but it's all tied up in growth stocks that don't pay dividends. Then retirement arrives, and the question becomes unavoidable. How do I actually live? The answer is usually to sell shares. But that means you're no longer living on what your assets produce. You're living on the assets themselves. Every withdrawal shrinks the portfolio, and one bad market year early in retirement can do permanent damage. And this one cannot be overstated. Retiring with a mortgage, it's one of the most damaging financial decisions a person can make. It dramatically raises the income you need each year and increases your expo to market risk. If you're carrying a mortgage into retirement, your portfolio has to work that much harder just to cover those fixed housing costs. That in turn can force you into riskier investment behavior at the exact stage of life when flexibility matters most. The solution is straightforward, even if it's not always easy. Pay off the house first, then retire. If that means working a few extra years, those years can often buy decades of peace of mind. Retirement is simply much easier when housing costs are low and predictable. Finally, I've observed a lack of diversification. Some people put everything into stocks. Others go all in on real estate. A few park nearly everything in safe assets. All of those approaches share the same fundamental flaw: concentration. Math sometimes suggests investing beats paying off a low-interest loan. But retirement isn't purely a math equation. It's about security. It's about peace of mind. It's about knowing you have a place to live that can't be taken away because your monthly payment became unmanageable. If you're younger, the strategy is relatively straightforward. Buy less house than you can afford. Choose a shorter mortgage if possible and pay it down aggressively. Aim to have it paid off by 60 or even earlier if you can, so you can spend those final years before retirement building other assets without a mortgage draining your cash flow. If you're older and the mortgage is still large, you have a decision to make. Pay it down with urgency, work longer if necessary, or plan to downsize and eliminate the payment. What you can't do is retire with a large mortgage and simply hope it all works out. Retiring with a big mortgage payment is one of the easiest ways to turn retirement into financial prez from day one. A paid-off home, or at least very low housing costs, makes the entire retirement plan far easier to sustain. Let's recap those 5 essential retirement assets. Dividend growth stocks, your primary income engine growing over time. An S&P 500 index fund for long-term growth and backup capital. Income real estate, or REITs, for stable cash flow that often rises with inflation. TIPS, or I bonds, for inflation protection and stability. And of course, paid off housing for lower expenses and higher flexibility. These 5 assets work together because they each protect you from a different risk. Market crashes, inflation, longevity, and unexpected expenses. Once you understand that, the next question becomes obvious. How much should you have in each category, and how do you avoid the common mistakes people make? When you put these 5 assets together, something important happens. Your retirement stops, depending on luck. Market crashes, your real estate income and inflation-protected securities remain relatively stable. High inflation, your dividend-paying companies and rental income can adjust upward over time, living longer than expected. Your index fund continues compounding in the background. Unexpected expenses. Your paid-off home keeps your baseline costs low. That's not just hope, that's structure. It's a retirement built on confidence. Confidence rooted in assets that have proven themselves over decades across wars, recessions, inflationary periods, and market booms. Knowing what to own is only half the equation. I've seen so many retirements over my long life, and one pattern always holds true. The good ones belong to people who built the right assets, the bad ones, sadly, to those who didn't. The difference isn't luck or even raw intelligence. It's preparation, plain and simple. Diversification isn't about maximizing returns, you see. It's about something far more fundamental, survival and consistency. It means that no single economic event can completely wreck your retirement. That's why a solid retirement framework includes different asset types, each covering a different risk. Together, they're stronger than any single category on its own. Another critical mistake I've observed is simply starting too late. This is the most unforgiving error of all. You simply cannot build a durable retirement portfolio in just 5 years. It takes time. Time for dividends to grow, mortgages to be paid down, properties to appreciate, and index funds to compound. If you're in your 20s or 30s, time is your greatest advantage, so use it wisely. If you're in your 40s, you need to act decisively and consistently. And if you're in your 50s and haven't yet started, the margin for error becomes very thin. You'll need focus, discipline, and a sense of urgency. If you're in your 60s without these assets in place, the reality can be quite harsh. You might need to work longer or significantly adjust your expectations. There's simply no shortcut that can replace decades of compounding. That's not pessimism. It's just arithmetic. The strategy, of course, changes depending on where you are in life. If you're in your 30s, focus on building your index fund and starting your dividend portfolio. Time is doing most of the heavy lifting for you at this stage. Real estate can always come later. If you're in your 40s, consider adding income-producing real estate and accelerating your dividend investing. Start paying down that mortgage aggressively. If you're in your 50s, begin building inflation protection into your portfolio. If you build these 5 assets consistently, retirement becomes manageable, not necessarily extravagant, mind you, but secure, calm, predictable, and free from that constant financial anxiety. So my challenge to you is this. After hearing this, don't just nod along. Take action today. Just one action. Buy your first dividend-paying stock. Invest in a low-cost index fund. Research rental properties or REITs. purchase inflation-protected securities, make an extra mortgage payment, one step today, another next week, another next month. That's how real portfolios are built, not through dramatic moves, but through steady, repeated action. The good retirements belong to people who built the right assets. The bad ones belong to people who didn't. The difference is preparation or the lack of it. By the time people reach retirement age, the outcome is usually already decided, not because of luck or intelligence, but because of the choices they made along the way. I've seen this play out repeatedly over decades. Some people enter retirement calm, confident, and in control. Others enter anxious, constrained, and worried about every dollar. The difference is almost never income alone. It's whether they built the right assets early enough and stayed disciplined long enough. Retirement doesn't reward last-minute effort. It rewards long-term structure, eliminating uncertainty. Most people don't fail because they make terrible decisions. They fail because they delay good ones. They assume they'll figure it out later. They assume there will be time. They assume something external will save them. But time is the one thing retirement planning does not forgive. Compounding only works when you give it years, sometimes decades, to operate. Dividend income only becomes powerful after it's been growing for a long time. Real estate only becomes meaningful after mortgages are paid down and rents have had time to rise. Index funds only reveal their full strength when left untouched through multiple market cycles. You cannot replicate that process at the end. That's why action matters more than information. You don't need to build everything at once. You don't need to be perfect. You don't need a complex plan. You need to start one account, one asset, one decision made deliberately, then another, week after week, year after year. This is how people quietly succeed at retirement, while others wonder why it feels so hard. If you're younger, your advantage is time. Use it while it's available. If you're in mid-career, your advantage is earning power, directed intentionally. If you're nearing retirement, your advantage is clarity. Act decisively. What you cannot afford is inaction. Retirement is not an event. It's a phase of life that arrives whether you are ready or not. And when it arrives, it doesn't care about intentions. It only reflects preparation. I've watched people assume Social Security would carry them. It didn't. I've watched people rely entirely on market growth. One downturn changed everything. I've seen people underestimate inflation, watched it erode their lifestyle year after year. But I've also watched others quietly, methodically build the right assets and retire without fear. Not wealthy beyond Mia, not extravagant, but secure, independent, at peace. That's what these 5 assets provide. Not luxury, not shortcuts, but dignity, stability, and control. So I want to leave you with this final challenge. Don't wait for the right time. Don't wait for certainty. Don't wait until everything feels comfortable. Pick one asset today and act. Open the account, make the purchase, pay down the balance, begin the process, then repeat. Your future retired self isn't asking for perfection. They're asking for effort applied early and consistently. Build the assets, stay disciplined, and when retirement arrives, meet it with confidence instead of fear. That's the path. Follow it, and retirement can become one of the most stable, rewarding phases of your life rather than one of the most stressful.